Today we're going to explore some of the pros and cons of investing in commercial real estate. Firstly, let us discuss what we mean by commercial real estate. For some reason that I don't understand, in many parts of the world, apartment buildings are considered commercial real estate for mortgaging purposes and appraisal evaluation purposes. But in my mind, apartment buildings are merely large-scale residential because people still live there. So my definition of residential property is property that people have as residences, and my definition of commercial property is property where commerce is conducted. So let's explore some of the areas of commercial real estate. It includes retail, like shops. It includes offices and warehouses and industrial and mixed use. Mixed use is where you might have commercial on the ground floor and there may be some residential up above. And there are many other kinds, of course. There's hospitality, such as hotels and motels, and travel industry related, like airports or storage facilities. They are all governed by commercial lease documents, and therefore they fall into the category of commercial real estate. One of the cons of commercial real estate is there's this perception that it often requires more capital. Commercial buildings are simply more expensive in general, and secondly, everyone thinks that banks have a lower LTV, a loan-to-value ratio that they're willing to offer, typically only 50 or 60% of the purchase price. So therefore, the perception is you need a lot more money. It's not altogether untrue. Not only are commercial buildings pricier than residential, but banks will also typically lend you only 60% of the value of the building as opposed to 80% of a residential property. This means that you often have to find private money to fund the rest of the deal. Well, that's true, but as we'll see, there are ways around that where, because it's commercial, you can more easily get 100% financing than if it's residential. A second potential con is that there's often more risk. Now, how this works is high leverage can be scary for many people. Because commercial loans tend to be bigger and mortgage payments tend to be higher, if you experience high vacancy for longer than expected, you are at a greater risk of defaulting on a loan. Certainly, if you've got $10 million deployed in the residential market, you might have 20 or 30 homes and your risk is spread, whereas that same money can be deployed in just buying one commercial building, and if you lose that tenant, you could be in default and lose the lot. However, if you buy right, I think you can mitigate that risk very easily. As an aside though, while it's true that if you have $10 million in residential properties, it could be spread over 20 or 30 homes, whereas if you have that same $10 million in a commercial building, you're more vulnerable in that if you lose your one tenant, you could lose the entire property. But having said that, remember this, if you've got that $10 million deployed in residential property, you've got maybe 60 or 80 lavatories to look after, you've got 30 tenancies to look after, and 30 roofs that might leak. Whereas that same capital deployed in that one commercial building means you've got one commercial lease contract and 3 lavatories and only 1 roof. In other words, there are economies of scales. The con is both a pro as well as a potential con. You've got to think of these things in balance. And if your idea is to own $10 million of real estate, then maybe you want them spread over a number of homes. But if you want to go to 100 million, then maybe you don't want to expand that residential concept of having dozens and dozens of tenants and lavatories. The commercial real estate offers some streamlining and economies of scale. Another potential disadvantage concerns institutional investors. Because commercial buildings are a good investment where a lot of capital can be deployed, they are often competed over by institutional investors. This high demand inflates their cost as the other bids are priced into the final purchase price. In other words, lots of institutional investors looking at commercial real estate can drive the price up. And while that is intellectually true or academically true, here's the deal. If you and I were to go out and look around at commercial deals and we found one, might be a corner shop or a little storage unit or whatever, and if it cash flows nicely, and the fact that it's commercial means we don't have to deal with people as often as we would with residential, then it's a good deal, whether institutional investors are after big deals or not. And to counter this a little bit as well, institutional investors have also been getting in big time in the last 5 years into residential properties. Big companies like Blackstone and even Zillow were buying up residential homes at an enormously high rate compared with what they used to do before. So even though this is potentially a detracting point of commercial real estate, I wouldn't worry about it too much. There are always great deals out there. Remember, the deal of the decade comes along about once a week. Rather than reading too many articles about the downside of commercial real estate, go out there and find one of your deals of the decade this week. So now let's turn our attention to some of the advantages of commercial real estate. And the first one concerns the fact that the value of a commercial building is not tied to comps. When it comes to residential property, whereas the value of a house is mostly rigid and dependent on the houses around it, the value of a commercial property depends on the tenant. By finding a tenant who's willing to pay twice the rental of what a current tenant is paying, the building will be valued at twice the price. That's because the value of a commercial building is a multiple of that rental income. And the bank will qualify you for a bigger loan. I love this fact about commercial real estate because we can have some influence in who is there. We cannot renew the lease on a tenant that's not performing, or if a tenant hasn't performed and has failed to meet their lease obligations, they get thrown out, so to speak. You don't renew the lease for them. So we can choose and select and encourage a really good tenant to be there. And if they're a higher paying tenant, the value of the building will go up. We'll be able to borrow more money from the bank. This is a tremendous advantage where you can directly affect and have an influence on the value of your portfolio in a way that you can't begin to do with residential property. Related to this is income potential. Again, because the rents are determined by the quality of the tenant rather than the building, the potential upside of commercial property is much higher than that of a residential property. A single deal could net you thousands every year and change your life. Think about it. Just by changing your tenancy from, say, a thrift shop to a coffee shop could put a jump start into the rental you're collecting every month. Therefore, the value of your building, therefore how much you can borrow from that building, it can improve your life forever, and it's a one-off task to change out that tenant. I love that about commercial real estate. The next advantage we're going to look at has to do with what's called triple net leases. Now that's a bit of a mouthful, but think about it this way. Let's say you own residential properties and you have tenants who pay you rent. From that rent, you as the landlord have to pay certain expenses such as property taxes, insurance, and maintenance. This is standard practice. In other words, if your raw return that you're getting from your tenant is, say, 8%, by the time you pay for these three expenses of property taxes, insurance, and maintenance, your return might only be 5 or 5.5%. This is normal and standard in the residential industry right throughout the world. But similarly, throughout the world, when it comes to commercial leases, it is standard practice, not universal, but it's very common for the leases to be so-called triple net leases. This means that in addition to paying the base rent, it is the tenant who pays for the property taxes, insurance, and maintenance. That means that the rent you collect from the tenant is net of those three items, hence the name triple net lease. But it means that your returns tend to be much higher. And by the way, if halfway through the year, the city council determines that they're going to increase the property taxes, or if the insurance company increases the premiums on the insurance, you can pass that on to the tenant. This makes commercial real estate investing very efficient compared with residential real estate. To find out more about how you can benefit by investing in real estate, especially commercial real estate, click the link below to get a free copy of my book. You'll pay just shipping and handling, called Real Estate Riches. You know, when I think about it, the National Association of Realtors has only ever endorsed 3 books, and they're all books that I've written. So this is one that they've endorsed. It was on the New York Times bestseller list for 7 months straight. It's been translated into 5 languages and been on bestseller lists in 14 countries. Join the vast multitudes of people who've benefited from this, who've been inspired to realize just why real estate is so good. Click the link to get your free copy, which will be shipped to you straight away. Today, we've explored some of the pros and cons of investing in commercial real estate. Some of them were real advantages and disadvantages, and some of them were just perceived advantages and disadvantages. But if you've enjoyed this, if you've learned something, please click the subscribe and like buttons, and make sure to check out my next video where I'll be sharing more with you on how you can become financially free through investing in real estate.